up on your screen with price changes. Well, about 1/3% higher on the mid-cap index coming through. So that's the opening rates. We are above 26,000, and I think, of course, we are, after breaching the 40-day exponential, we are holding above it, and I think we should be closer to the little closer to the 20-day as well for the Nifty and for the Nifty Bank as well. Steel stocks up there, so JSW Steel and Tata Steel. But, you know, you got 40 out of the 50 names higher. TCS is on the other side. Mahindra and Indigo come up as well. So it's a 70-point start, higher start for the Nifty. Surabhi.
Yeah, indeed, we are above both the 50-day and the 20-day now at 26,000. Nifty's managed to climb back. And steel is the big morning trade, like I pointed out earlier. So JSW Steel, after the races, 3% up. Tata Steel up about 2%. Remember, the safeguard duty has come back at the original level, at least for the next 1 odd year, or next couple of months at least, and then it gradually tapers down. But that's a sigh of relief for the domestic steel manufacturers. BEL is the other one that's up and about. Actually, speaking of BEL, let's pull up Bharat Forge because they won an order for these carbines yesterday, over 1,600 crores of an order. There's some green on Bharat Forge as well. Adani Ports, Jio Financial, Adani Enterprises, Bajaj Finserv. So it's pretty mixed. Some of the large cap banks are doing okay. Axis and Kotak, for instance, both have gains of about 0.5% each. Reliance is a nice support for the bulls, 0.5% up. Lever is supporting, 0.5% higher. So all in all, it's a pretty decent looking screen. 75 up on the Nifty. So getting ready to welcome in 2026 in style, it would seem. On the downside, actually, you just have a couple of auto stocks. Eicher Motor, M&M losing some ground. There's also Bharti Airtel, which is lower by about 0.5%. Other than that, it's all looking good. And we've got 3/4 of a century on the board for the Nifty. Mangalam.
Well, 3/4 of a century on the board for Nifty, doing extremely well. The broader market is doing well too. As one would imagine, you know, global spirits on the last day of the year, a lot of these spirit names are doing well. So global spirits is up around 5%. We've also seen, as it is the wont of the start of a new year, RITES Wellness is up 2.5%. There has been a Motilal Oswal initiating coverage on the company. Remember, this company offers a lot of no sugar substitutes or low fat, high functional products. Typically, people make New Year's resolutions to that extent as well. So the stock doing fairly well this morning. Though we've seen some bit of a decline in Hindustan Copper, though I believe that, you know, at lower levels, Hindustan Copper has seen purchase and recovers from the low. So I'll be interested in seeing how that pans out as we move forward. HFCL is up around 3.5%. SAIL continues to do well. We've seen some decline in PB Fintech. It's not been a good week for them, down 3.5% for that stock. Federal Bank is the other one, which is lower today at the open. And 361 WAM is another stock which is down by about 1%. All in all, more stocks advancing than the number of stocks which are declining.
Okay, I think 1670 stocks are higher and about 650 stocks are lower. This is still, I mean, early days, but that is what's coming through. What else, right? And the KPI Green, maybe a few other names, is coming up with large volumes. It's up 5% right now, KPI Green. Orient Tech was a big mover yesterday. I think it was circuit up yesterday, Orient Tech. It's up another 7%. There is BSC, which is coming up with about a 2% pop, so 2630. I'm just not looking at price change, but price along with volume. Samman Capital is coming up with about a 2.5% bump, so 144. There is Deepak Fertilizer. Yesterday, a few of these fertilizer companies were bouncing around 4% on Deepak Fertilizer. HEG is up about 2%. There is, I think you can go down the list, but volumes will start to fade. Viatec Vabag, I thought there was a brokerage call on this one, 2.5% higher, but volumes are not very large or anything. Shakti Pumps has fallen quite a bit from the highs, 2% on this one. Solar Industries is up about 2% or so as well. So that's the sort of overall picture, overall perspective. And I think you guys mentioned the Privy Specialty name, right?
Trade, yeah.
13% lower. Of course, that block's gone through. Hindustan Copper is down. Hindustan Zinc is down. And of course, all these silver ETFs are down about 1.5%, 2% as well. But that's basically just swinging around with respect to what's happening to the underlying commodity.
Very curious to know if there are users of steel which get impacted by the higher price of steel. We are looking at some of these metal stocks do extremely well. So there's JSW Steel, Tata Steel, but on the opposite side we do have Eicher Motors, which is lower, M&M, which is lower, auto stocks. So I don't know whether some of these auto stocks which are consumers of flat steel could get impacted on the negative side.
By the way, Mangalam, tomorrow we'll have to do some pull this up, and we'll do it. There's EU has this green steel regulation.
Yeah.
So steel which is made by greener manner, well, not renewables completely.
Yeah.
That goes into effect tomorrow. So there is. I remember reading that we don't export too much steel. I mean, most of the steel is consumed here in India, but for those like Tata Steel, etc., which have operations overseas. Exports into the EU region, perhaps we'll have to see. We'll get some perspective on this, because this is, of course, a broader issue. A lot of steel factories in China have been converting this, going into in preparation, because they're large exporters into the EU, etc. as well. So that's the other thing.
By virtue of my conversations with Sonal, who tracks the climate space very closely, she's been saying that this will be a bit of a concern from an industrial standpoint as well. Yeah.
I just want to point out that one of the reasons why you're seeing these big outsized moves on steel counters here today is one, that there seems to be an immediate shift. So from the non-ferrous trade, people are quickly hopping onto the ferrous trade. And the other is that the safeguard duties that have been announced, it's not only for 2-3 months. Now there's a very clear roadmap. So the duty stays at 12% up until the end of the current fiscal. That's 31st of March, 2026. The next entire year, it stays at 11.5%, so tapers down from 12% to 11.5%. And then the following fiscal, FY28, it comes down to 11%. So there's a lot of clarity now in terms of how the duties are going to play out. Of course, the government could come out with tweaks as and when it feels necessary. But for the time being, this seems to be the indication. So fair amount of clarity on steel names. But I think we have our next guest now joining in.
Yeah, Vineet Sambre is Head of Equities at DSP Mutual Fund. Vineet, season's greetings, and let me say this at the outset instead of the end. Happy New Year 2026.
Wish you the same, Prashant, and the team.
Vineet, 25 was not a great year here in India, but it's been a great year for many other markets around the world. Hope is that things will turn for the better here. While we wait for triggers and things to happen, do you think time correction wise and price correction wise, valuations are now reasonable, or you think that still is the number one headwind in that sense? What's your sense overall, Vineet?
So I think, Prashant, this is I think you've hit the most important aspect, which is the market's valuation. And I feel that, the headwinds which we faced last year, 2025, was very unusual. In a way, we had all the global uncertainties. We had, we ourselves going through a bit of a slowdown where corporate earnings actually did hit a low patch. But despite that, we've not seen, if we just look at the aggregate valuation at the Nifty level, we've not seen as much correction as we faced the headwinds as far as the macroeconomy is concerned. And while the macroeconomic economy now looks okay with whatever the government has done in terms of the reforms, the interest rate coming down, maybe the corporate earnings also should start gradually limping up. But in terms of the valuations, I don't see that there is a great margin of safety to start maybe looking at in a big way. There are two ways to think. Either the valuations become really reasonable for one to start looking at from absolute investments perspective, or maybe there is a clarity in terms of the earnings catching up momentum. So I think these two need to get sorted before we see clear directions for the market, at least for the 2026 is what I feel.
What are appearing as attractive bets right now for the next year?
So, I think the bets doesn't change. The year has changed, but I think from the overall, if I just take the top-down perspective, interest rate beneficiaries are the ones which comes to the top of my mind. And from that perspective, the lending institutions and more prominently the NBFCs is something which will see the benefits of the interest cost. And that's where one pocket which I think should do well. Beyond that, I would imagine that one has to look at some cycle recovery. I was hoping for a consumer-oriented beneficiaries as well because of the reforms, the disposable income going up. But consumer sector as such is actually going through a lot of disruptions. So one has to be very, very selective and careful because what used to be very dominant franchisees across the board, I think they are facing a lot of threats, both in terms of competition or in terms of the online presence. So I think there one has to be more selective. In terms of the cycle recovery, I would say power sector went through unusual slowdown because of the extended monsoon. So there, I believe one can see a turnaround. And one more space which I am actually positive on is the agrochemical space, because that's one space which has again got affected because of the unusual season. And the stocks are actually trading quite cheap in a way as compared to the history. So I think that's one space to sort of focus on.
Vineet, hi. Great to be speaking with you, and season's greetings to you and your team and all at home. Now, you're someone who's been a specialist in picking stocks in a debate which rages in this market between whether there's alpha or no alpha. Is it the time to go passive? You're someone who's excelled at picking those hidden gems and those opportunities, right? So therefore, my first question to you is this. Whether 2026 will see a pivot back to the mid and small cap market or not, because if I was looking at the fund positioning at your end, so if you look at the DSP Flexi Cap, where the fund manager has full freedom to move on whichever side, you guys are still more large cap oriented. 60% of that fund is large cap, 40% is mid and small. So therefore, are you entering 26 with the same sense of caution that it's going to be a large cap driven market?
See, actually, while these are the debates which keeps happening, but at the time of building portfolios, it all finally boils down to what companies are eventually going to deliver outperformance. And from that perspective, the differentiation between the large, mid, and small doesn't remain as much as we think from the top-down perspective. But broadly, if I have to think, 1 or 2 years can be really differentiating in terms of whether large caps outperforms or mid caps, small caps outperforms. But if one actually just pulls the period for a longer term, I believe the small and mid caps in India, they have good potential to keep outperforming the large caps. Now, while I say that, last year was not great relatively for the small caps as compared to the large caps. Maybe this year also it could underperform, but I'm saying that I see a lot of opportunities, like you said, by looking at the companies bottom up, that the companies will do really well over the course of next few years, and that's where the confidence of the small and mid caps doing well. So I think one has to maybe be rational around how to balance, because the timelines is something which is very difficult to predict.
Let me also ask you a slightly more academic conversation this morning, but let me just pick your brain on this. The other trend that at least I've noticed as someone reporting on the market for so many years is that mid and small cap investing has also become very trend oriented. When the trend is in your favor and when that particular theme or sector is the flavor of the market, stock prices can go through the roof. I mean, multiples can expand to 100 PE at the blink of an eye, right? And then when the sector starts derating in a matter of sometimes months, if even not even years, then the drawdowns are equally sharp. I mean, EMS is one example of it. We've had so many other renewables as a theme. When the theme is right, stocks will run, then they'll crash. Same for these platform companies. So is this the nature of the beast? Is this the kind of high volatility that you just have to live with? You have to trade the trends and time them right if you want to invest in mid caps and small caps.
So I think I still believe that in the end, long-term fundamentals will matter. But I think you're right. We are also observing that the last few years has been very different. And there are two components to it out here. So one is that the classification, especially as far as the mid caps are concerned, you have those 150 stocks to sort of work with. Now there are the diversified funds which are also looking at the mid caps as a universe. Mid caps themselves are looking at the mid cap as a universe, and at the same time we had this new set of investors who are still, this financialization of saving which is taking place is pumping in so much money into the funds. So I think there's a chase for the near-term momentum, and wherever the earnings are seems like inflecting upwards or downwards in at both sides. that's where we are seeing the flows also actually moving up and down. And I think you can maybe do some small research whenever the stocks move out of the mid cap and gets into large cap. That's where the the rally halts in a way, despite the maybe the earnings performance being there. So which is also a factor where the fund flow also matters a lot. So I think these momentum bit is actually going to be part and parcel of the short term trades maybe, and the markets are more right now aligned to those moves. But I think in the long term, eventually what will matter is that durable earnings and such, the competitive business are going to sort of outperform is still the belief I have.
Yeah, I mean, and forget mid and small caps. That's happened in the large cap space as well, right? Trent would be an example of when the market loves you, it really loves you. When it wants to forget you, well, it just moves on. But I guess that's the nature of the beast, and that's
That's life.
Yeah, at least in the Indian context, I think because of the demand-supply mismatch, like Vineet is also saying, it's something that we just have to learn to live with.
Yeah, and it's also a function. I mean, there's no direct correlation here, but there's perhaps could also be a function of the way hype is generated on social media, or all forms of conversations that people have, because every aspect of conversation is magnified because of more people speaking about it, and then timelines are narrowed as well. But let's go back to the basics. Vineet, you've liked the IT spaces. It's a contra buy for you, so to say. You've been a contra positive here. Some of the mid-cap names, and then very recently we had that big deal with Coforge as well. What is your thesis on the IT space, and if you can say something like a deal that Coforge did?
See, first of all, I continue with my sort of positive view, and it's more also linked to where the valuations are for the sector as compared to most parts of the market. We've seen that the sector is actually pricing in some of the big risks which we are talking about. Risk being the uncertain environment, risk being the poor deal flow, risk being the AI trade which is happening globally. So now I believe that these risks are well priced in the stocks. I mean, last year 2025 the IT sector has underperformed. From that perspective, any change in the outlook globally can lead to a turn in the sentiments, and also the outcomes could be good. As far as the likes of Coforge is concerned, I think broadly for the IT sector, companies will have to go for investing into new technologies. They will have to adopt. Otherwise, I think I see a risk of companies also actually shrinking in terms of their overall outlook going forward. So I think companies which are actually taking that call, I would want to sort of give them the benefit of doubt. Only thing is that they have to be rational in terms of their pricing, what they're paying. They have to also, if somebody is paying a higher price like what Coforge did, I think they have to justify by way of showing high growth going forward, and which I think the management there has demonstrated in the past, which is where we still want to give them the benefit of doubt. Now, acquisitions generally have not been great. If you look at the history, 70% of the acquisitions fail. So that is there, and hence I think the companies will have to be extremely careful in terms of their due diligence and go for it. But I think there's no escape. They will have to invest. Just giving money out as dividend will not serve the purpose in the long term, is what I feel.
Again, Vineet, just going back and looking at the portfolios, obviously you love banks and financials. That forms a large chunk of many of the DSP funds. There's IT that we've discussed. And actually, at least in the flexi cap, I see less exposure to capital markets. So let's actually talk about financials, Vineet. How much of the good news and the excitement, pickup in credit growth, improvement in margins, how much of that is already priced in? Because financial stocks have rallied 15% to 50% in some cases this year.
By the way, if you just look at the 2025 returns, ICICI Bank has not given any return. I mean, it has been flat. So I think all what we speak about the credit environment changing, I think the large banks have really not outperformed as much, and maybe there's space out there to see not very high growth, but at least linked to the credit growth in the system this year, and maybe the asset quality benefit should also be there for the banks. But I think beyond that, I feel that the banks which are, or the NBFCs which are actually trading at let's say slightly higher valuations, it's on the back of high growth. Now, as I see the environment, I believe the lower cost of funds should benefit the NBFCs more. We had, the current event where the foreign investors have also invested in the NBFCs. I believe that they will continue to show high growth. They will be beneficiary of low cost of funds, and hence the premium valuation should sustain out there. So I think a combination of maybe a large bank, a couple of NBFCs, sectors where one could see inflection going forward. I mean, and NBFCs focusing on those. I think it's a good way to look at the financials in that format.
All right, it will be very interesting to see if there is any change in the competitive dynamic out there with the kind of FII flow that has come in the large NBFCs as well. One of them which has been surging right now is Shriram Finance, up now 71% in this year itself. Vineet, hang in there. We'll ask you your views on some of the commodities space as well, if you have a thought here. Sudarshan joins in on steel safeguard duty, because that's the big story of this morning. JSW Steel now around 4.5% higher. We've seen a big move across the steel space. Sudarshan, it's definitely a positive and a big one at that.
It's come as a booster for the sector which was already in the focus over the last few days, tracking global metal prices, and that have been moving higher. If you remember, in the April of 2025, DGTR, that is Directorate General of Trade Remedies, had announced temporary safeguard duty, and that was applicable for 200 days. And it expired in the early part of November. Now, finally, government has come out and imposed safeguard duty to protect the domestic industry, which was facing basically from the imports, higher imports from China, Vietnam, and other countries. Now, this safeguard duty would be applicable for next 3 years. And it will be effective from 21st of April 2025. So in the first year, from April 2025 to April 2026, the duty is of 12%. After April 2026 to April 2027, that duty comes down to 11.5%, and from 2027 to 2028, that comes down to 11%. So overall, after the temporary safeguard duty for 200 days, now this duty is being imposed over 3 years. That's the reason you are seeing a big move in all the metal names, especially steel companies. Top Nifty gainers, JSW Steel, Tata Steel, JSW Steel up more than 4%. Similar move is being seen even in the mid-cap names.
All right, Sudarshan, thanks a lot for that. So big moves on all the steel names. I'm not sure, Vineet, you actively invest in commodity cycles, because that's not your typical style. But do you think because of higher input prices, some of the users, you've been liking autos, auto ancillaries, etc., do they stand to get impacted negatively?
Yes, surely I think they will be impacted because both the ferrous, non-ferrous commodity prices have been going up. But I would continue with my positive view around the auto anchs, because I believe the changes which are taking place in the auto sector is significant, and I think that auto anchs are the best way to play that. And auto anchs are just not a way to play what's happening in the auto sector, but if you look at a few of the companies, they've also started getting into the adjacent categories, and that is linked to their engineering skills. So, some of the companies are now, tied up with Apple to be supplying to the Apple ecosystem, and that can be a very big opportunity going forward. So, I believe overall auto anchs, the next course of 3-4 years should be a good proposition. And given the fact that even within the auto sector, this whole transition from ICE to EV, if that actually catches up, a lot of companies have also align themselves to serve both the categories in a way. So I see a lot of change in the sector, and these companies to be beneficiary out of that. Now, this commodity pricing could be near-term headwinds for a while, but given the opportunity and the growth prospects, I would continue to have a positive out there.
Okay. All right, Vineet, we'll wind up the conversation on that note. Thank you so much for joining in. And once again, wish you and your team, everybody at home, a very, very happy New Year. Thank you for joining. Well, with that, let's move on and put the spotlight on Blue Star. That's the next company on our radar. Now, it's been a tough year for the room air conditioning business, overall for the air conditioning business, because of unseasonal rain for the better part of 2025. In fact, this is something that Blue Star has already acknowledged during its several quarterly calls, saying that in all probability, FY26 is going to be a flat year, but this is not a structural issue. It's a cyclical factor that's played out this year. So let's understand what the latest trends are like. We have with us Mr. B. Tyagarajan, MD of Blue Star, joining in. Mr. Tyagarajan, thanks so much for being with us. Season's greetings to you. When I say season's greetings, I don't know how it sounds. I mean, when I talk to a company in the business of air conditioning, right? Because the season was really not in your favor this time around. We have a couple of points. I'll just put that on the board for our viewers as well to define the conversation. Obviously, we want to figure out where the whole air conditioning cycle is going. Is there hope of a better 2026? So we want to understand what the inventory position is like. And really, in terms of the various segments of the company beyond unitary cooling products, how the other segments are likely to fare. So, Mr. Tyagarajan, I come back to the season's greetings and hopefully wishing for better seasons ahead for the air conditioning industry as well. But really tell us, let's pick up from our last conversation where you told us, and you're always as candid, that it's very difficult for the second half to make up for the losses that we've seen in the first half. So are you still at that same level of guidance at best case in terms of top line, this will be a flat year? Or has there been some growth post the GST cuts?
Good morning, Shilpi. It is always a pleasure interacting with you. Season's greetings to you, your audience, your colleagues in CNBC-TV18. Never in the past 5 years, it was a COVID year. One wanted the year to end faster. So I am looking forward to this 2025 ending as early as possible, a few hours away. It was a bad year. It was the poor summer season. There was a GST blackout and inventory pileup. And the good news is November, December has been good. You could see the movement of goods both in primary and secondary sales. And one look forward to the summer season, which should set in end of February. So that's about the room air conditioner market. And even if it is going to be flat or, let's say -5% compared with the previous year, we are comparing with a year which was an exceptional year, FY 25. But CAGR, if you look at it, even if it is FY 20 to 25, FY 23 to 25, it is above 19%. So I'm not worried about the demand that is going to be there and the prospects for the industry.
Yeah.
It is that it was a bad year.
So actually, I mean, what you're saying, and I don't know if you meant that for Blue Star or for the industry, if you're saying that the room AC business will end 5% lower, that's actually better than what you had said earlier. Earlier you said it could be as low as 15% this year. That's for Blue Star, right?
No, I'm talking about the industry growth. I'm talking again end March 2026. There is a possibility that it ends with -5 or flat. It all depends on how the summer demand is going to be. But equally, as I mentioned, that it can be even -10%. We don't know. But the important point I'm saying is that it is compared with the FY 25, which was an exceptional year. Unprecedented growth was there, over 35% for the full year. Summer season alone was over 55%.
Yeah.
So therefore, the CAGR is maintained. And given that never in the past two summer seasons were washout, I think it will go on well. So I look forward to FY 27 in a big way, or the summer season 2026 to be a good season.
Yeah. Mr. Tyagarajan, good morning and the season's greetings. I'm going to talk about something which is like forecasting the market, forecasting the weather, which is our colleague Manisha, who has a close eye on all things weather and commodities, tells us that this is a La Nina phase. Now, I'm no expert, but broadly what it suggests is that it's basically cooler temperatures, cooler winter, and maybe extending all the way into April, June of next year. Slightly more cooler temperatures. Isn't that the sort of peak season with regards to build out of for the AC industry to meet that summer demand? So would you expect these conditions to affect FY 27 numbers as well? I mean, if this were to persist, what's your sense?
I have talked about this. It's not the real temperature that matters. It is the humidity. And in it, even if it is above 35 degrees centigrade, one would like to be in an air-conditioned environment. And you are used to air conditioning in a metro railway or a bus or a car or in the office or in the shopping mall, cinema theater, restaurant. So this category has to grow. It is, we are talking about a 35,000 to 40,000 rupee product, and the penetration levels are lower. So I don't think it has to be a long summer of 45 degree plus, etc. We have seen in the past, all that it requires is 2 to 3 weeks of discomfort.
High humidity. Just to understand that from an inventory perspective as well, you said that inventory has started getting cleared up in this November-December period. So typically, what is a normal inventory cycle or a normal inventory level for you? And as opposed to that, where is the situation now? What is the situation now?
From a manufacturer point of view, 45 days would be an ideal inventory, given that it is an Indian manufacturing ecosystem and the component ecosystem is good now compared with what it was 4 or 5 years ago. That in Blue Star's case, it was crossing 60 days. And I think by end of December, we should get there to 45-day kind of inventory. In any case, there is a energy label change which will come into effect midnight today, which means you have to either relabel the product or you have to liquidate that. But in the market, my estimate is that till around end of February, there will be enough inventory available.
Right.
If the summer sets in, then the new energy label products should begin to move.
Mr. Tyagarajan, we've spoken a lot about air conditioners and how this year has been terrible for them. But one category, which was the category of this year in the consumer durable space, was air purifiers, because we saw a big jump in air purifier sales, as we saw a big jump in deterioration in the quality of air as well. How much does that account for in your overall pie this year, and how do you expect the dynamics of that category to change over the next, say, 3 to 5 years? How big is the opportunity?
Good morning, Mangalam. It is negligible. The total market size is less than 500 crores. And it's basically two cities, Delhi followed by Mumbai. And there is all kinds of products exist there. There is no certification of a product that how do you know this air purifier is going to be doing what it is supposed to do. Starting from some 6,000 rupee onwards till 50,000 rupees air purifiers are getting sold. It's not going to make a big difference at all. The room air conditioner is the largest in a complete air conditioner. It is much larger than even commercial air conditioner.
Right. And finally, in terms of competition and market share, well, the industry was under pressure all of this year. Have you held on to your market share? And what is it that you're targeting for the next year?
We have improved our market share. While the growth has not been there, we have improved our market share. And I think as the market begins to grow again, you will see intense competition, and I think that is inevitable. You need to compete. You have to deliver growth. You have to deliver the margins, and it is going to be intense competition. There is no doubt about it at all.
Can you give us an FY27 outlook in terms of revenue, margins, and market share that you're targeting before we let you go?
So I'm talking again about room air conditioner. If you compare with the FY26, it will be exceptional, but that is not the way to compare. Internally, we would like to compare with the FY25. And over FY25, if 15% growth one delivers, it will be exceptional. And the margin should get back to margin outlook of 8 to 8.5% in room air conditioner. That should happen. And as you are aware, the B2B products, whether it is projects or commercial air conditioning, it was again a bad year. The order inflows were not that great. Only the factories and data center segments supported us. The large projects, there have been inordinate delay in
Right.
causing concern. So therefore, FI26 should be good for that business also. That's what I'm hoping.
All right, FI27, 15% growth over FI25 with margins between 8 to 8.5% for the room air conditioner business would be something that you are targeting. Let's see whether the weather supports or not. You are holding on to your market share.
One thing, Mangalam, is absolutely clear. And I just want to say that, Mr. Tyagarajan, I think if you look at long-range forecast, right, number one demand for energy is cooling.
Yes.
I mean, there's no doubt. I mean, in India, globally, I mean, I think air conditioners play an important role. But since we are doing this and having this conversation, slightly near-term focus with regards to hotter, cooler summer, etc. matter. But that's in the very near term. Thank you very much, Mr. Tyagarajan. Really appreciate your time and wishing you a very happy and prosperous 26, sir.
Same to you, Prashant. All the best to you. Thank you.
Okay, we'll take a quick commercial break here and we'll come back and we've got an interesting discussion lined up on the jewelry space and the rise of the lab-grown diamond industry. One of the largest jewelry organized jewelry player in the country now, stepping up their game there. So it's an interesting discussion with two players in the space coming up on the other side. Stay tuned.
Well, it's been a good start to this ultimate session of 2025. The consumer stocks actually doing well. We have HUL, which has moved higher, Asian Paints is higher, and none higher than Titan, which has actually moved to the highest point of trade after it's announced. In this month itself, the stock's done well. It's closer to its record high than ever before. It's over 4,000 rupees. It's announced its foray into lab-grown diamond after a very long time. Here on CNBC TV18, we've been asking the management for many years, and they've said that they're looking at this market very closely, but they didn't make any plans public until December 29th, where they launched their first store, Beyond, in Mumbai. Managing Director Ajay Chawla told CNBC TV18 exclusively that he expects to close this financial year with a few more Beyond stores. And how will this impact other players in the industry? How will this impact the industry itself? We're joined by Ishwar Iyer, who's the CFO at International Gemological Institute. Basically, this is a company that certifies lab-grown diamonds, the leader out there. And Prajay Maganlal, who's the CEO at Elevate Lab Diamonds as well. Prajay, let's ask you, up until now, lab-grown diamonds were looked at as a child which wasn't loved as much by the parents, but loved a lot by their friends. So consumers loved lab-grown diamonds, but the large players were still looking at it with some sort of skepticism or something that may eat into their own overall business as well. Now with Titan actually finally shaking its hands with that child and saying that we're part of this, we're in this together. They've opened this, and the largest player, the most trustworthy player enters this space. Do you think it gives it a little more legitimacy than what it earlier had? And what does this do to the industry according to you?
Well, Titan entering the industry, right, provides institutional validity. It tells us that the market has now reached the stage of maturity where big players are getting involved. And Titan has actually been giving signs that they're looking at this industry pretty closely over the last 1 year. Malabar is doing the same. Number of other big players are doing the same. So I see this moving forward as a market of segmentation and choice, not really of disruption. There's absolutely going to be space for both natural and lab grown, and Titan getting into it just proves that.
All right. And what does that mean for your volumes? Ishwar, I have to ask you that in terms of tests. Have you, will you be participating in testing some of these LGDs for Titan, or will they buy LGDs from people who you've tested for already? What does that do to a business like yours?
Well, good morning and thanks for having me on the show. Yeah, so of course, we've been talking about this over the last 3-4 quarters in our analyst call, etc. I think we continue to maintain that IGI will be certifying diamonds. So we are a neutral body. We are a third-party independent grading body. So, and we've also mentioned this in the past that the lab-grown segment is the new entrant for the industry. And the lab-grown jewelry segment is starting to see some serious growth in India. I think in line with those industry trends, I think there are a lot of larger players now coming into the field. As we've spoken in the past, I think the lab-grown segment was first adopted by the US consumers. And as the Indian consumers also come into the fray, I think we just at the start of a very, very big cycle as far as lab-grown jewelry demand is concerned, as far as the Indian market is concerned. So obviously, IGI is well positioned today to manage this diverse portfolio of grading services that we provide.
Right. So, just to go back to what we were speaking with Prajay. Prajay, what is the total sales of LGDs in India right now as per you? And with Titan entering it, the mature market, do you think it can accelerate the demand? And what does that do to prices of natural diamonds?
Sure. So just a few numbers, right? Today, diamond jewelry makes up about 10% of the Indian jewelry market. LGDs within that space, till just a few years back, were about just 1% of that market. Today, LGDs have moved to about 3%. So they're roughly around $300 to $400 million is the lab-grown diamond jewelry industry here. With Titan entering the market and with other larger players entering the market, we are going to see about a 25% CAGR over the next 10 years. Easily moving to, say, about 3 to 10 billion in lab-grown diamonds itself, because we see lab-grown diamonds moving to about 10% of the market in about 10 years. If you just take the trends from the US, right, in 2018, just 2% of engagement rings had lab-grown diamonds, whereas today it's well over 50%. And the US market is structurally different, where they have a hero product in engagement rings. About 50% of the US jewelry market is just made up of engagement rings. And when you say there's a larger chunk of lab-grown diamonds taking place, that's a huge cultural shift. We see India getting trends about 2-3 years later. And the Indian lab-grown market is already booming. We're seeing it in terms of customer choice. We're seeing it in terms of design philosophy. And with big players entering the market, that just proves that lab-grown is just here to grow now.
But do you think that lab-grown in India will be different in consumer behavior than what it is in the US? Because jewelry purchase in India itself is different versus what we've seen in the US, etc. We buy more for value reasons than adornment.
Absolutely. If you look at the two reasons why natural diamonds were so popular, at least in the past, one is it was a social and financial flex. If you wore a 2-3 carat natural diamond, that proved that you were someone in society. It also was a pretty good hedge against inflation, which consistently outpaced or even beat inflation in many years. Both those things don't hold today. With the larger share of Gen Z moving into the market, with their philosophies changing, towards more responsibly sourced, sustainably and ethically sourced diamonds, they also want to adorn themselves with a far wider range of diamonds and gemstones. We're not just talking about lab-grown diamonds here. We get lab-grown gemstones, colored gemstones. India has such a rich history of colored gemstones, but today it's just 2% of the jewelry market. Whereas in America, that's actually moved to 10 to 15%. We are seeing a kind of explosion in terms of design philosophies, in terms of product outcomes that just weren't possible with natural diamonds because of the high cost. So it's completely turning the market on its head. And I just see it growing from here because of all these changes.
Have the prices of natural solitaires moved over the last year or two?
I'm sorry, I didn't get that.
How have the prices of natural solitaires moved over the last year or two?
Oh, natural solitaire prices have plummeted about 30-40%. I think Ishwar may be able to correct, but I think it's about at that number.
All right. Ishwar, I'll ask you a little about natural as well. And this could, I don't know how this impacts you, because Titans, apart from announcing this lab-grown foray, they've also gone all out in natural diamonds, saying that, you know, the new Tanishq stores have a natural diamond purity meter, quite similar to what they had done with the carat meter when they had first launched. That was an industry disruption. And now everyone's looking at the carat meter as a necessity before they go ahead and buy gold. So do you think this could be something like that? And if Titan were to do it, why would anyone come to IGI?
I think there's an important aspect that we all need to consider in terms of an independent certifier. I think IGI plays that role because there's obviously a need for segregation of duty, or as you say, you know, avoid of conflict in terms of the certification of diamond goes. So as an independent body, I think the need for an independent body to continue to grade diamonds is an important aspect of the entire industry, the way it functions today, in terms of providing that sort of sanctity to the final consumer who's buying this product. So from that context, I think the need for an independent certification will continue to exist well into the future. But having said, you know, just to add to some of the points that was mentioned earlier, I think there's also an aspect of prices of gold and silver, which have really moved up over the last 6-8 months. You know, lab-grown with their pricing at the moment provides that balance from a budgetary standpoint for consumers to therefore participate on a larger scale as far as purchasing lab-grown jewelry is concerned. I think there are a lot of dynamics that is currently at play in this industry in terms of the way prices of gold, silver have moved, etc. And therefore, you know, the lab-grown segment therefore has the potential to really leapfrog over natural diamonds in the future. All right. We'll take that and also see how that impacts your overall business, because realization is lower in lab-grown for your testing, while you know, the volumes are a lot higher. Will that offset each other for your business to sustainably grow, basis your guidance? Something that the street will keep watching out for going forward. Prajay, last word. With Titan entering, how does that change the supply side dynamics? Yes, demand, we understand, can grow about 20-25%. Earlier in the past, there were reports of oversupply in the lab-grown business. Do you think with a larger player entering here, that gets mitigated a little bit?
I think there is a tremendous supply, and especially with the high tariffs being put up by the US, that actually reduced prices quite a bit in the last, say, 2-3 months, because a lot of the supply that was going to the US today is now being flooded in India. So I absolutely don't see Titan entering the market, putting upward pressure on prices. There's plenty of supply to go around.
Okay, all right. Mangalam, so you're buying a diamond or no?
Natural, lab-grown, anything.
Lab-grown.
I'm sure people at home wouldn't mind.
It's of no use to me, to be very honest.
I'll tell you, tomorrow is the first, right? So come in with some bling.
Yeah.
Come in with the bling.
Buy with, you know, one of those chains with some...
Look like a rap singer, maybe, I guess.
Gentlemen, thank you very much for joining us. Good speaking with both of you. Very interesting and fascinating discussion. Wishing you the best for 26. Appreciate it.
Yeah, best wishes for
Sparkling
the
2026.
Thanks for having us on, guys.
All right. Well, Nagaraj Sethi is with us for HDFC Securities with a quick word on the market before we go any further. 55 points up, so 25,990. Nagaraj, what would you recommend? Indices, stocks, both?
Yes, good morning, Prashant. Yes, Nifty found some support around 25,800 levels. The higher tops and higher bottoms on the daily chart is indicating there is a possibility of buying emerging at the lower levels. And the overall near-term chart remains intact. We are moving in a range at the higher, though Nifty facing stiff resistance around 26,200, 26,300 odd levels. At the lower levels, consistent buying is coming, which is indicative of higher tops and bottoms on the daily and weekly charts. So market is preparing for a base, and we could see Nifty sailing towards 26,300, 250, 300 levels in the near term. And I have two stocks to discuss. First one is from the PSU banking side, Indian Bank. Chartically, Indian Bank has been moving in a range-bound action over the last couple of weeks, and since yesterday it has broken out the range. the overall chart pattern is looking positive. Currently trading around 824, 825 levels. One can look to buy at this point of time. 875 is going to be the immediate target. One can place a stop loss at 790. And the second one is Industover. Industover has been in a constant uprun over the last many months. The larger degree chart pattern is indicating a strong bullish bias for the stock price. Currently showing a consolidation moment at the highs and expected to break above the consolidation moment. Currently trading around 425.50, 426. One can look to buy at this point of time. Initial upside target would be around 450, 455 levels, and one can place a stop loss at 415.
Okay, all right, Nagaraj, we'll leave it on that note. Thank you very much for all the trading ideas for now. By the way, the mid-cap market is doing really well. The mid-cap index is up 0.5%, outperforming the Nifty quite nicely. So it's so far so good on the last day of 2025. Let's do one thing. We'll take a break, come back with the commodities on the other side. We'll ask Manisha about all that sparkle and all that volatility in the precious metals market. Well, it's the end of the year and we are finishing it off in style and sparkle. You just heard that discussion on lab-grown diamonds. Now, whether they're lab-grown or natural, you need to embed them in some precious metal. And those metals have been driving everybody really up and down all over the place. Let's go to Manisha now. Manisha, my goodness, again, 7% down, 5% lower, then 7% higher. What's the latest now?
This is not looking like an year-end at all, the way the markets are moving. But just because you were talking about the diamonds there, if you look at the natural diamonds, the smaller category, that prices have declined by 10% in this year. And the lab-grown prices have declined by 22% in this year. Is the reason people are not buying so much gold and silver, but they are buying studded jewelry, which has, diamonds of whichever kind into that. But we'll talk about commodities that are actually traded. And I want to start with crude oil prices because this is the only one that has seen a very sharp decline. It's the biggest annual decline since 2020 coming in for the crude oil prices. And we are down by 18% in 2025. 2025 actually is the third straight year that you have seen a negative return come in for the crude oil prices. Well, it is supply glut, which seems to be overweighing the geopolitical tensions in the global markets, and that has kept the prices in check and in the negative there. Now, let's talk about the positives. And yes, today, even as it is 31st of December, you have seen big moves come in for many of these commodities. I'll start with copper, and we are trading at near all-time highs in US. on London Metal Exchange, in Shanghai, and in the Indian markets as well. So when you look at the copper prices, we are up by 45% in 2025, and this is the best annual gain that you have seen since 2009 come in for copper. Take a look at aluminum, and that one is trading at a 3-year highs. We have seen 17% of gains come in for aluminum in this year. Zinc is up at a 1-year highs, and 5% of gains is what it's given you in 2025. Let's talk about the precious metal prices now. And well, yes, the CME margin hikes do kick in today after business hours, so that they come in force from 1st of January. So it's not really going to be a holiday, because you will see big price moves continuing there. Silver is up 162% in this year, best annual gain since 1979. Gold is up 66% in this year, 53 record highs in this year, and the best year that we've seen since 1979 as well. Take a look at palladium prices. We're trading at a 3-year highs onto this one, and 73% gains here. Platinum prices have hit all-time highs in this year, and we are trading with 123% gains in sense of platinum as well. I mean, show me in equity markets and other asset classes, and you haven't seen that kind of a move come in the way we've seen in precious metals there. I also want to talk to you about soft commodities, and they haven't done well, and it's the reason that you weren't worried about the inflation part of it, because rice is trading near 8-year lows in the international markets. It's a 32% of a decline. Cotton is trading at a 2-month highs, but with the kind the year has gone by with higher surpluses in major producing countries, it's down by 6%. You have rubber, which is trading at an 8-month highs currently, but that also has seen a 7% decline in this year till time. And then the declines just about continue, because when you look at the sugar prices, well, that is trading at 2021 lows, and we have seen 23% of a decline come in for the sugar prices. Soybean is the only one trading on the higher side there. But when you look at the coffee prices, we also have seen a very erratic year, but 10% of gains in coffee is how we're closing this year. So that perhaps is what your leeway is from 31st December to 1st Jan.
That's not bad. In diamonds down 10%, coffee up 10%. I think we can deal with it. But yes, the precious metals rally has been the one that's absolutely breathtaking. Thank you for that, Manisha. Well, with that, we will take a very quick break. But on the other side, we get to discussing one of the biggest themes of 2025, data centers. The boom is well and truly underway here in India. Whom does it benefit? What is the kind of build-out we're talking about? And where is the investment opportunity? We'll discuss this with Amit Sareen of Anantraj and Darshan Hiranandani of Yota Data Services.
Okay, welcome back. India's data center capacity is set for a massive surge, projected to expand nearly tenfold by the end of 2030. What's driving this explosive growth? Who stands to benefit the most? Winnie is here with some perspective, and we dive straight in after that into a very interesting discussion. Winnie, take it away.
Right, thanks for that. So India's data center sector has marked 2025 as the breakout year. Capacity expanded from 0.5 gigawatt in 2020 to 1.6 gigawatt in 2025, fueled by 30 times the data traffic rise since 2017. 900 million internet users also came into India, and AI usage started increasing. And what was interesting that made OpenAI India market, OpenAI's second largest market. Now, in 2025, what more did we see? We saw mega investments that came in. Reliance Industries unveiled world's largest Jamnagar data center plus 1 gigawatt AI facility with NVIDIA. TCS launched its Hyperworld for 1 to 1.2 gigawatt AI-graded capacity over the period of 5 years. OpenAI committed to 1 gigawatt amid DPDP Act mandates. Now, the total announcement that came in for 2025 hit $63 billion. $43 billion was ex of Reliance. So, yes, $20 billion approximately was Reliance. Now, with hyperscalers leasing 97.9 megawatt in first half itself, 48% increase over there is what we're seeing on a year-on-year basis. Occupancy at 97%. Mumbai dominating 50% share as well. Now, India added a record 30 gigawatt renewables in FY24-25, making it third globally, enabled by cheap solar power, supportive government as well. For renewables versus other countries, how do we stand for AI data centers, which needs 5 to 6 times more energy? Now, power demand from data centers globally is estimated to grow at a CAGR of 17% till 2030. For India, it's expected at 33%. And with the US and EU power queues that are increasing there, execution timelines are increasing, there is permitting delays across the globe because of all these issues. The focus now shifts to India. India's data center capacity is projected to increase rapidly in the coming years, and obviously because of the factors I mentioned. Now, it's interesting to note that when data centers are created, 45% of it is capex cost, is non-IT equipments capex. Whether you look at it like a cooling system, electricals, construction, etc., which accounts to most of the costs. IT costs come in at 55%. And India has no dearth of players in terms for equipment play, whether you look at an L&T for EPC, Cummins for backup power, there is infrastructure that is required, there are cooling systems that is required, so we have Voltas for that. Wiring, Polycab could benefit from that as well. So this will boost what? L&T, Cummins, Voltas, a dearth of companies that we have that will benefit from this as well. Now, in US, when you look at it, utilities present in the right region or even in companies which have access to electricity have seen a bigger success in the US versus other companies. In India, currently, most data centers are present, located in Mumbai region. 50% capacity is in the Mumbai region. Why? This is due to network access that is there via undersea cables. Further, when you look at it and break down India versus US, unlike US, India is one nation, one grid. Although transmission is becoming a big bottleneck similar to US, but India's data center capacity is maybe set to rise almost 5 times to 8 gigawatts by 2030. And this is according to Jefferies. Setting up 1 megawatt of data center in India requires a capex of $4 to $5 million, and hence setting up incremental data center capacity of 6.4 gigawatt by 2030 will need a capex of around $30 billion. Should create many opportunities for real estate players, electrical power systems, fit-out players, cooling systems, and network infrastructure players as well, which are among the top beneficiaries for the data center boom. And Indian telecom players, EPC players, power players, IT players, all these are set to benefit going forward with this data center boom.
Vinny, thanks very much. That's very, very useful context for our discussion now. Amit Sareen is with us, Managing Director at Anantraj. Amit, good to have you with us here. We also have Darshan Hiranandani, Chairman and Co-founder at Yota Data Services. Darshan, good morning. Great to have you with us here, as always. First up, season's greetings to both of you. And I think, for much of the industry and markets overall, I don't think we can say 25 has been great, but I think for your industry, it's been pivotal. at least in terms of what we are seeing globally and maybe what we are seeing here in India as well. Vinny put out some of those numbers, and Darshan, I want to start with you. There is this demand for AI compute, which needs data centers, which in turn requires power. I mean, I think every 3 months, forecasts for how much incremental spend will go into data centers has kept getting bumped up. This is what we've seen through the course of 2025. And it's a moving number, but it's always higher. So just give us your perspective. Where do we stand at this point in the industry, in the build-out in that sense? Give us a brief global perspective, and then bulk of the discussion I want to focus on India. Go on, Darshan.
Okay, so basically, India was playing two types of catch-up. One, we were playing catch-up on conventional cloud, which is just the shortage of data center capacity that we had for our regular compute that was stored overseas. And the market predicted that by 2030, that itself needed to go from our present 1.5 gigawatts to 3 gigawatts. Now, just to let you guys know, moving from 1.5 gigawatts to 3 gigawatts, everybody only talks about data center capex. But the point is, you can't have a data center unless you don't have computers and servers in those data centers. So just at a very high level, if 1 gigawatt or let's say 1 gigawatt, or we want to add 1.5 gigawatts of conventional cloud, that will cost 6 million of capex per megawatt. So you're talking about $9 billion of capex just needed in making the buildings with MEP. This is if we are going to 3. I'm not even talking about 6 and 9 and 10. I'm just talking about 3. Second is you need 20 million per megawatt of cloud capacity. So that we are talking about another 30 billion in capex just in your regular conventional cloud capex of regular CPUs, servers, networking, storage, some amount of software systems to enable that. So just to do our regular CPU catch up, we need around $40 billion just there in the next 5 years. This is without AI.
Okay, Darshan, sorry, let's just take it slowly. Lots of numbers there. What's the capacity now?
About 1.5 gigawatts.
Okay, you're saying to go to
1.6, doesn't matter.
Okay, so to go to 3,
yeah,
which is to add about 1.5 gigawatt, you're saying what's the total, everything included, MEP, cost of land and building and the servers, computers, everything? It's how much, what's the investment required?
Minimum we require around 40 billion.
Vinny put some of those numbers out, and that some of the commitments have been made in that sense, right, Darshan?
Yeah. So now let's look at what those commitments entail, right? So, for example, in some cases it is a full cloud commit. In some cases, it is just a data center commit. If it is an AI commit, then the megawattage is lower. So, for example, there's a big announcement in one of the eastern states in Andhra about a big data center complex coming there and a big hyperscaler location coming there. Now, if that is going to be used for AI, then the cost is almost 40-50 million a megawatt, right? And then if you say, they've announced 15 billion of capex or announcements over the next 7-10 years to be deployed, that actually is only 300 megawatts. So when we are talking about getting to 3, 4, 5 gigawatts, we genuinely have to build these data centers, connect them, get customers, put it up, deploy the cloud, and make it all happen.
Yeah, Darshan, sorry.
Let's look at it at minimum.
Yeah.
At minimum, we are saying that we will go to 3. We are likely going to go to 5 gigawatts by 2030. So somewhere between 3 and 5.
And the cost, I mean, data center.
The capex for that. Yeah. The capex for that will be somewhere in the order of $70 to $80 billion in getting there.
So
this estimates are, because you said per megawatt cost for conventional cloud and AI is vastly different. Is almost double.
That's only for this compute. So I would say it's around 6. Let's say. Yeah, okay, almost double, 70% more.
So the number, Darshan, that you gave us, which is roughly speaking investments of up to 60 to 70 billion dollars to build this capacity of 3 gigawatts plus by 2030. This is for We're not talking AI-enabled data centers, or does it? These are just the cloud-enabled or the one step below AI data centers. Got that? So that kind of gives us a broad framework to work with. Now, here's the thing. I'm going to ask the question that all investors have on their mind. This is a multi-year opportunity that I think there's no debate around. The question is, how can investors play it until the time that we have scale, and a lot of these data centers are put and packaged, say, in InvITs. Now you have REITs, so you can play real estate through that. Till we have the whole InvITization happen, people are trying to sort of move ahead of the curve. So Amit, come in over here. So construction, land and development, just creating the housing structure is one part of it on which some capex is going. But I don't know if that is the most interesting way of playing the data center opportunity. From a real estate standpoint, what's in it for you? And where do you see the value add coming in?
Surabhi, this is where we start. The first thing, like Darshan rightly pointed out, the first thing which we need for a data center is the land in the building.
Yeah.
But that is just the starting point. And then it starts from there. We've been working in the data center space now at Anantraj for almost about 7 years now. We started this in 2019 when our founder chairman, decided that we are going to go into this. Today at Anantraj, we have 157 megawatts of buildings which are now ready and which are now getting converted. And we have 28 megawatts of co-location already there. So the way we are approaching it, we've kept it very simple. We feel that the data center business in India is going to grow in two segments, basically. And then, of course, there is AI and there is a whole new world to it. But these two things are going to be required by everybody who wants to come into data centers. The first is co-location. When you go up to the rack and you provide the complete infrastructure, which is what Anantraj started with. And once we delivered that product, we got very good demand for it. And, based on the product which we delivered in the market, we also got demand for cloud, which is infrastructure as a service. Cloud in itself is a huge horizon. It comes, AI is one part, and then there are several other parts. But the way we looked at it, Anantraj, was we initially started with infrastructure as a service on the basis of cloud, where, of course, the investment is almost 4 times more than what you do in co-location. We did that, and today we, last year in October, we started Ashok Cloud, and we got phenomenal response for it.
So Amit, help us understand. I'm sort of going into level 2 now. From a business standpoint, basically a margin perspective, you're making investments. So what is the kind of ROI? What is the kind of margin that this business is going to fetch you? Like you said, there's the base model, which is this co-location, taking a spot on the server. And then the other model, which is more high-end infrastructure as a service. Just give us the business dynamics, the margin profile, and the ROI on both of these.
Surabhi, the ROI when you start with co-location is almost 60 to 70%. And when you move from co-location to the cloud services, which is like we just told you initially, infrastructure as a service, which is like basic cloud, there the ROI even touches almost 80 to 85%. So as of now, this is a very lucrative thing to look at. And in spite of the ROIs we are telling you, India is amongst the cheapest, both in terms of capex and in terms of opex in the world. So that is a big advantage. As of now, we are all talking about only the Indian data getting localized. As you know that how this whole data center story started in our country was our Honorable Prime Minister was the first leader in the world who spoke about data localization. And today, India wants to localize its data. So as of now, we are focusing on this. But the advantages we have in India, both in terms of capex and opex, maybe after 2032, we can look at even importing data and keeping it here.
Okay. Got that. Darshan, this dire, if this build out has to happen, and globally we're actually talking about hundreds and hundreds of billions of dollars. I mean, if some of the numbers have to be believed, it's mind-boggling. And people will go through bouts of skepticism once in a while about whether this is all going to happen, etc., etc. And there is always this concern about too much commitment, overbuild. We've had, lots of these episodes earlier as well. Something changes, you realize that, well, productivity, the ROI, the realized ROI is not what you thought it was, or something like DeepSeek happens and everybody then, the cost of compute goes down significantly and you're already committed to all this investment. So things can change, and these are all questions. But in India, Darshan, do you think we are, like in most other sectors, so low in terms of actual capacity that even if all of this were to play out through 2026, the industry is set for, I mean, some of these things have been locked in at least for the next 2 years, 26 and 27?
No, I certainly think things have been locked in for till 2030 because the market has just woken up. They've hit the hammer into the ground. Today, it's going to take time to deliver results. Infrastructure can't be built overnight. Servers can't be delivered overnight. Cloud systems can't be connected overnight. So that's not going to happen anyways in a hurry. I think right now, the reality is we're looking in certainly next, I'd say 3 to 4 years, we are looking in at a very good run because even global capacities today are not really coming online in a large enough scale. So there's still a lot of announcements, still a lot of contracts, but large enough capacities haven't come online. But in an India perspective, we are very far behind even